Hi, I'm Joe, and I'm going to tell you.
And I'm Taylor. I'm back here too.
He's going to tell you, too.
I'm going to tell you.
We're going to tell you.
Even though Joe tells you.
Yeah, but if you wonder who I'm talking to at the beginning of every episode, that'd be Taylor. He's the producer, and he's the editor, and he's the chief executive officer, and he's the security, and he's the driver. He's what else do you do?
Nothing yet. I edit the most of the videos. I manage the YouTube channel. I manage the website. I manage the Twitter account. I manage the Facebook. Manage the Tumblr account. Manage the Reddit page. You know, just a couple things.
I'd be called the actor or the talent. So that means I could be replaced.
Yes.
Even though the show is called Joe Tells You. You can, in theory, get another Joe.
I'll get anybody named Joe.
Or somebody pretending to be Joe. Or be a Joe.
That'd be funny one day, or just in lieu of you, somebody else, and I'm Joe.
Could be in this garage.
Yeah.
Over here. It could happen. Stranger things have happened.
Our garage studio. But enough of that, Joe. Tell us. What are you telling us today?
I'm going to tell you, Taylor, about the different types of loans, because this comes in all the time. Mortgage loans we're going to talk about. I talk about all kinds of things. I'm going to rant about personal
more
things.
House stuff, Joe.
House stuff, money stuff, whatever. It's going to be a lot of house stuff at first, because I'm dealing with house stuff right now. But later I'll give you like other stuff too. Like we had one about at the age you should get a colonoscopy. I thought 38 was a little young, but some people, it's not. Not us, though.
That's quite a other side of the fence. That's mortgage loans and colonoscopy.
We can go over that, though.
We do have a broad range of subjects we tackle here.
We do. But I'm not an expert in colonoscopies.
Yet.
Not yet. But I will be. So, the different types of mortgage loans. Taylor?
Colonoscopy.
Okay. So, you might be wondering what is the difference between these crazy types of loans you see. You might have heard, this is what everyone says. Well, during the economic or before the recession, everyone was getting these crazy loans and they were getting foreclosed on. They couldn't afford their loans. And when they rolled over, they were, the payment was increased and they couldn't afford it. Well, I'm going to tell you why those payments increased and what type of loans they were and how to protect yourself and not get those type of loans. So I'll tell you first about the different types of loans that are available. The first and most common one that everyone gets when they first buy a home is called an FHA loan. What's that?
Federal Home Association.
Federal Housing Authority, I believe. So we could both be right or wrong depending.
That's FHIB.
Yes.
AIB, sorry.
We could both be wrong, but I'm probably not. So
A little from me, a little from you. Put them together.
since Taylor doesn't actually do this, he probably doesn't know what it is. But
You
federal,
can lie to me and tell me.
federal
I say,
something
okay.
was a good guess.
Yay.
I mean, usually with an F, it starts federal something, FDA and F this and F that.
FDR. Yeah.
Okay. So an FHA loan, what is that? Well, it's a government-backed loan. It is a loan that you can get a traditional 3.5% down payment. The loan has to be, the home has to be habitable, has to have working things, working plumbing, working toilet, working water heater, working heater, depending on the state that you live in. Usually they require like a heater to at least be working. It has to have carpet or flooring. It has to have no broken windows, stuff like that. So there are requirements to getting a loan. But what is the point of that loan? I mean, it's like a first-time buyer loan. It's a lower down payment, lower than a conventional. Not much. It's 3.5% as opposed to a conventional, which is a 5%. And your different properties that you want to get would have to also be FHA compliant. Sometimes condos could or could not be. Most of the time houses, single family residences are. So FHA would cover that. So this video is about the types of loans. We're going to do another one coming up, which is about the requirements to getting a loan. So this is just about the loans specifically, what the differences are. So if you're going to say, what does that come out to? Stop. There's another video about the requirements for getting those things. But as for what an FHA loan is, that is the rundown of what that is. So what's a conventional? Conventionals are basically offered from, FHAs are offered from most banks, so are conventionals. Conventional is a 5% down home loan, and the bank, depending on the bank, they'll require different things for the house. Usually can't be broken or destroyed or beat up or things like that. And what happens is if you have a home and you want to go conventional, it leaves you open to getting more homes. So some people, maybe they're not FHA compliant, maybe it's not FHA ready, or maybe they don't want to deal with FHA buyers. It's illegal, but what are you going to do? Sometimes they say no or don't want you to buy it. What are you going to do? Report them? They'll never tell you why they didn't accept you. They'll just say they didn't accept you.
What about the loans from the guy in the corner that gives you $5,000 named Tony?
Oh, that guy?
Yeah.
When we exited and
Yes.
we saw his sign? Don't go to that guy. Don't go to him at all. So conventional loans, 5% down. They're usually from the bank that you're getting it from. And the bank has their own requirements, which are traditionally more lenient than FHA's. And conventional can be traditionally 5%, or sometimes I've even seen another lender, depending on the area, they charge an additional 5%, so 10% total, because the area is maybe higher risk, or it's higher to being recession prone, or maybe the values dip down faster. So their conventional might start at 10% as opposed to 5%. So this is the one where people got into trouble, right? This is interest only and ARM loans. What are interest only and what are ARM loans? No, not these guns, not those guns for sure.
No, I don't have guns. Thank you.
Whatever Taylor's packing. He has something there. He's wearing a short sleeve. Can't see it. You'll see it on We Tell You. He'll show you what he's doing. So ARM loans mean that they adjust. They're called adjustable rate mortgage loans. So ARM is not ARMS. It's ARM. Adjustable rate mortgage. So the rate can adjust depending on the rate of inflation or the rate of loans, or what is the daily rate or the interest rate of loans at a time.
Is ARM an acronym for something?
Adjustable rate mortgage. Yeah, that's what
I
it is.
missed that. Sorry.
Sorry, no, it's okay.
Okay.
He's not required to listen to these things.
No, I may miss it. You were on your. I was at that threw me off. So I.
Because it was almost a salute, but I changed it real quick because I didn't want to be confused with being a Trump supporter.
I didn't even. Okay.
Yeah, exactly. Just shout out to everyone out there. They
Topical.
don't know where we stand. You'll never know. We'll never tell you.
Unless you watch it in the video.
Yeah, unless you watched it in the video where we told you exactly where we stood. My water bottle just clicked. So adjustable rate mortgages. Those are the ones if you want long-term stability to stay away from. You don't want an adjustable rate if you want to live in the property and have a stable mortgage payment. We were just talking about that with Taylor the other day. We were talking about if you have a 30-year fixed, which is usually a conventional or FHA, 30-year fixed means the payment is fixed for 30 years and so is the interest rate. So whatever the interest rate is now, you are fixing it against that interest rate. If the interest rate goes down, your payment is higher, obviously, because you fixed it at that whatever today's rate is. If the interest rate goes up, it's fixed. That's at that rate. So if the interest rates go up, which they most likely are, interest rates are at historic lows. Still, they're still pretty far down there. And in the early 90s, they were up even to like 10 and 12% to get home loans. Now they're at 3 to 4%, which is still amazing to get a home for that rate, which is great because the prices have gone up so dramatically. It's great to have low interest rates, right?
But won't they balance it out, really? Like if you think about it, like a low cost home back then with a 10% an interest rate, and now with a high cost home with a 3% interest rate, don't they kind of balance out?
You're referring to inflation, right? So like basically like if the house rates go up and they cost a certain amount of money, it'll balance out the margins or the profits or the inflation or the cost of the home because of that. Yeah. In some places, yes, some places, no. Like in California, for instance, California, San Francisco, New York, places that are hot commodities, hot markets for real estate, those don't follow the rules of inflation, don't follow the rules of having stable home prices. So basically, if you got a home back then at 15 or so percent and you were locked in for 30-year fixed and your mortgage was $150,000 and the rates went down in 2002, 2003 to 2 and 3%, you would want to refinance because you were locked in at a fixed rate at a high rate, and you refinance to a lower rate. So if you have a high-priced home, like now these days, you have a high-priced home and it's 3 or 4%, you want to lock yourself in early and often because rates have gone up and up and up. Because if you lock yourself in now, you can have that stable payment for the 30 years duration of the loan. So an ARM loan is the exact opposite of that. Depending on the ARM can be 3 years, 5 years, 7 years. It could be whatever the ARM rate is. The ARM traditionally gives you like a lower payment at first, so it's enticing. So if you're starting a family or need more funds available, but you want to get into homeownership, you don't want to pay the rate of a 30-year fix because it might be too high for you, you would get an ARM loan, and an ARM loan lets you pay that lower payment for whatever the length of the ARM is. And then after you go for that length, it'll adjust to the next rate. And then after that, you pay the higher rate. So ARM loans could be good depending on if you want to pay less money at first, but over the long-term stability, traditionally they're bad because when the rates go up, the ARM adjusts. So the other ones where people got into trouble with were interest-only loans, where you paid really, really low payments, interest only, for 5, 7, whatever years, like an ARM. But instead, once the ARM adjusted or once the interest 5 years passed, 7 years passed, then you would have to pay the interest and the mortgage payment. So the problem that people were having is, say you had a $500,000 home, your payment was $2,000 a month, it was interest only. The real rate for a $500,000 home would have been like $3,000 a month or closer to that. So once it adjusted to that rate during the middle of a recession, people didn't have jobs, they couldn't afford that new high payment because it adjusted, and at that same time caused a devastating effect to where people didn't have money and income and were unemployed, and in all of their adjustable rate mortgages or interest-only mortgages they had at the time adjusted, and they couldn't afford the payment. So that's where you get into trouble. The next thing are investor loans, things like that. Depending on different banks, usually you'll pay 20% down, which kind of a lot of money. 20%, obviously, if you do a $100,000 house, 3.5 FHA mortgage is $3,500. Conventional 5% is $5,000. And if you buy a $100,000 house, you have a 20% down loan, it's $20,000. So those are the different types of loans. That's a kind of an idea of what they are, what they mean for you. And we were just going to go over this because Taylor is interested in this subject lately. You
didn't mention, is the balloon kind of like an ARM?
Balloon is like an ARM as well, except the balloon is the payment. See, Taylor, he's got these great questions. He doesn't want to do these videos on finance all the time. And he's like coming out of like freaking left field with all these great questions on what these things are. So you think he doesn't know, and then he just surprises you with all these crazy questions.
Still don't know.
Yeah. So a balloon is like an ARM, but a balloon would be the payment of the balloon. So if you had a low payment for 5, 10, 15, whatever years, a balloon payment would be a large payment or the rest of the loan payment. So what would happen would be you would have, if you had a $100,000 home loan, you would have $50,000 of that paid between the first 5, 10, or 15 years, and that would be your payment, right? At the end of that loan period, you would have to pay the rest of the money back. So depending on which loan and which way you were set up and what amount you got, at the end of the balloon, you would have the money paid at the end of that. Also, you just reminded me about jumbo loans. What's a jumbo loan?
The clown?
No. Jumbo loans are anything jumbo. And what's jumbo?
Big.
Jumbo is over, the current rate is $417,000. So everyone will lend you up to $417,000. This really needs to change for California prices because it is long past $417,000. They rent to you at up to $417,000 as a conventional FHA regular loan. If it goes up above $417,000, that's what is now called a jumbo loan. So they have different rates and they have different down payments. So basically everything in Orange County, Los Angeles, stuff like that is a jumbo loan, and those are a little bit higher rates. It might require more of a down payment.
Is there a reason why you would want a jumbo loan, or is kind of you put it in that position where you have to have one?
For example, say a certain property that you were interested in.
Maybe
if you got a loan on that property at your regular down payment, 3.5% or 5%, and it was above the $417,000, you'd be paying a jumbo loan rate. And depending on the bank, the interest could be higher or they might require more of a down payment. Now, if you get a gift fund of, I don't know, say
a certain amount of money,
a
gift fund means somebody gives you money.
Someone gives you money for your down payment or for a part of the purchase of it.
Like essentially somebody helps you with a car, they give you help with the down payment for the car.
Yeah, exactly.
The same with the home.
So with a gift fund or something like that, what would happen is they would give you that money, and enough of that down payment would give you would take the down payment or that money from the gift off of the loan amount, and the loan could go under the jumbo, and it can go to like a traditional regular mortgage, or you can even get a better interest rate because it went below that rate. So basically the loan amount is the loan amount you're taking out after you've paid your down payment and everything else. So your loan amount minus the 5% or the 3.5%, whatever down payment that you're paying, that would be the loan amount, and that's what you determine if it was jumbo or not, or regular. So we're talking about high amounts of money here because it's California and it's what we deal with all the time. But depending on your situation and different state you live in, you'll probably be below that mark. But if you live in California, and you're pretty much screwed. So we have to come up with other creative, funny ways around those things. We'll tell you about that on the Joe Tells You Funny Ways to Get Around Things show. But that's Joe telling you and Taylor
It's always me.
about the types of loans.